Okay, this is part 2 of chapter 12, and this section is mostly focused on financial ratios. All right, so now remember, you're right out of 2021, so that financial statement, the contents of the statements, what accounts are on what statement and what they look like should be pretty close to the front of your head. Okay, you should remember that. You need to remember it anyway. But we're looking at financial ratios here, so we're going to look at different categories like liquidity, and then efficiency ratios, solvency, and how solvency ratios are used by long-term creditors, and then finally profitability and liquidity. Okay? All right, so we're going to start out with liquidity, and this is all about cash. So these are our 5 categories here: liquidity, efficiency, solvency, profitability, and then stock investments. Okay? In our liquidity ratios, we've got basically 3 ratios here: working capital, a current ratio, and the quick ratio. Now, you've actually seen these before also, okay? But it's good to review them and good to have it in your head. And when you think about managerial accounting, you want to have an impact and sort of an idea about how changes that we make and business decisions that we make will affect these ratios. Okay, so the current ratio is not is a whole number. All right, it's simply the difference between current assets and current liabilities. Now notice it's not total assets and total liabilities, it's just current. Okay, so this would tell us that we've got $579,000 more to pay off our after we've paid our bills. That's really all that it says. In some ways it measures your ability to pay short-term obligations, and it might be important to suppliers. But if you want to compare it to another business or to the same company in prior years, then you need an actual ratio like this. Okay, this number is like normalized. So if we take our current assets and divide it by current liabilities, this tells me I've got 5.81 times more current assets than current liabilities. Now this you can compare it to any other company, well, especially in the same industry, okay, but that's really a good number. So yeah, I think that's all I've got to say. For the quick ratio, though, the quick ratio takes into account that current assets has like prepaid insurance in it, it's got supplies, it's got a bunch of goofy things that aren't really turning into cash really fast. Okay, so that if you want to measure what's really turning into cash, then we're going to go to a quick ratio. All right, so this takes cash, short-term investments. These are short-term investments that don't have any time constraints on them. We can turn them into cash right away. Okay, plus net accounts receivable. That's net of the allowance for uncollectible accounts. Okay, divided by current liabilities, excuse me, and that gives us 5.22. Okay, so it's a little bit less than the current ratio, but it's a better number probably if you're really evaluating cash. Okay, so this shows that this company is actually in an excellent liquidity position. It's got plenty of money to pay its creditors. Now, efficiency ratios, these are what's important to management, and a manager may well be evaluated based on these. Okay, so for inventory turnover, okay, so that tells us how many times our inventory goes out the door. Like if you look at the balance sheet, how many times did that inventory completely change? The more that it changes, the better for the company. Okay, so here we take cost of goods sold, 748, 679, and divide it by average inventory. Now that average is beginning of the year plus end of the year divided by 2. And this is just an example of one way to do this, but you really need, I've got hiccups, I'm sorry, you need an average number here. You can't use like just end of year's number, just one snapshot number. You need something that represents the whole year, because cost of goods sold is over the whole year. Okay, so cost of goods sold divided by average inventory. This tells us that our inventory turned over almost once a month. Okay, so you can compare this to other companies in the same industry. That's a good number. And then accounts receivable turnover is also a really important one. This tells us, are we getting our cash in? Is this slow or is cash coming in? So here I've got net credit sales, 374, divided by average accounts receivable. So accounts receivable, again, is going to be an average. We need something that represents the full year. So we just got beginning and ending divided by 2 here. A company would really use something more sophisticated than this, but this is fine. And this tells us that accounts receivable turned over 14.6 times. Okay, so that's an excellent. They're collecting their accounts receivable. That's really good news. Here are some more efficiency ratios that are important to management. The day's sales, 1 day's sales. So if you take net credit sales divided by 365 days, this tells us that on average per day we're selling $1,026. Okay, now we can compare this to ourselves in prior years, but I don't know if you can really do it outside. You'd have to have a company that really matched you on a lot of different variables for it to be meaningful. And then the last one is the average days in accounts receivable, days sales in accounts receivable. So we can take that 1 day's sales here, can't take it apart, and divide that into the average net accounts receivable, and that tells us that, say, accounts receivable, that it's in there for one sale for about 24.9 days. Okay? The credit sales are collected in about 24.9 days. So this is good. All right, those are all good numbers. Now, solvency ratios, these are important to long-term creditors, and we're only going to look at a couple of them here. They're important to bankers, long-term creditors, and it's how are they to pay their long-term debts. So the debt ratio is total liabilities divided by total assets. Okay, so our total liabilities are 45% of total assets. Okay, and the times interest earned ratio, that's 30.1. That says that they're in a good position to pay the interest on their long-term debt. This is another issue, okay, whether or not you can pay the interest. So we've got income from operations divided by interest expense. I can pay for it 30 times. Okay, so those are also all positive numbers, or results anyway. Now here's some profitability. Profitability is always nice because we can always relate to an income statement, right? And this is, this is net income divided by net sales is return on sales. Now when you see the words return on, think that return on is net income. That's what it is. That's what return on is. So this is net income divided by sales. Return on sales. Okay, so we're getting 34 cents in net income for every dollar of sales revenue. Okay, that's excellent. Okay, and you want to compare this to your competitors or to yourself in prior years. You definitely don't want it to go down. Return on total assets. Return on total assets. So in this case, we're going to take net income, and we're going to add interest expense back to it. Okay, because it's a different animal. This is the return on assets that it's invested into. So we're going to add the interest back, and we take our average total assets and divide it into this, and we're getting a 97% return. Okay, so the hotel's doing a really good job earning a return on the assets in which it's invested. And here are some more profitability ratios, and again, another return on. So this is return on common stockholders' equity. Now, for a common shareholder, it's like, well, how much of a return am I getting on what I've invested in this company? So this is net income minus preferred dividends, because this is the income that's available to common shareholders, right? Net income minus preferred dividends divided by average common stockholders' equity. So here it is, we didn't have any dividends here. It's $28.85 divided by average common stockholders' equity. So this again is beginning plus ending divided by 2, 175%. So so they're earning like $1.75 for each dollar that they've invested. Okay, and remember that whenever you see this like average, whenever you've got a balance sheet number down here as the denominator, like average common stockholders' equity, It has to be an average. It can never be like an as-at number. It has to be an average because we're looking at a balance sheet number over a long period of time. Okay? And then earnings per share, net income divided by preferred dividends declared divided by the average number of common shares outstanding. Okay, I always think weighted average, but I guess we can just use that. So again, we didn't have any dividends. We've got 100,000 shares outstanding, 28.85. Now notice that it's not, that this is net income earned over a full year. Okay, but we're taking an average number of, it's actually a weighted average number of common shares outstanding because those shares for the full year earn that net income. Okay, so that's 28.85. Okay, more ratios. A PE ratio. These are important for analysts. Price earnings ratio. Market price per common share divided by earnings per share. That's your price over earnings. So then you can say that this investor, that they're earning about 6%. That's the price to earnings. You paid $175 for the share and it's earning $28.85, so it's paying 6 times the cost of it. Or that's its earnings. Yeah. So we're earning 6.06%, and it's not a percent. Dividend yield on common stock. This is a lot of ratios, isn't it? Dividend per share of common stock divided by the market price per share. So it's paying 4%. This is the dividend yield. Okay, this one is used a lot, this ratio, a PE ratio. You remember that? Price earnings ratio, you'll see that a lot in anything that you read about investments. And then the dividend yield is another one that's important. These will be different for different industries too. Like if you're investing in something that Elon Musk is creating, you're not doing it for the dividends. Okay, you're investing in it for the expectation of long-term growth. But if you're in a utility, for example, or a railroad, then you're looking at how much is this going to pay me every year. So this is paying $4 per share, and the market price per share is $175, so it's paying 2.2%. Okay, now it depends on what the market is like. That looks like a pretty low rate, but if banks are only paying 0.25% interest, then that's pretty good. Okay, so everything's relative, and it depends on how long you want to get tied into a stock too. And then finally, the book value per common share. This is something that you can compare to other companies. Book value per common share. You're going to take total stockholders' equity. I can't get in there. Minus preferred equity. And the reason why the preferred is subtracted is because this is really considered more like debt. Okay, plus the preferred shareholders get preference as to dividends. So that equity would not be available to the common shareholders. Okay? All right, but believe it or not, there aren't that many preferred shares. You'd be surprised. I mean, we do all this work learning everything about these, but in reality, you really don't see many out there. So total stockholders' equity minus preferred equity divided by the number of common shares outstanding. So 1948. Okay, that's the book value is much less than its current market price of $175. Okay, so the book value represents historical numbers based on past transactions. Okay, so the market value per share normally reflects what investors think the future earnings and performance of the company will be. So here's our where's our market value per share? Did I lose it completely? Well, maybe. This is all the liquidity. Maybe we didn't do it. Oh no, just the market value per share of $175. That's how you can compare it. Okay. So the book value is $19.48, and the market value of the stock, what it's selling for right now, is $175. But this includes future expectations. That's why it's important. Okay, we're getting there now. Now how analytics is transforming, it's changing everything. We've got lag indicators and lead indicators. You learn about that. You want to be able to determine what data is structured and what is unstructured, at least know what it is, and how it aids in managerial decision making, and how it enhances. We haven't talked about this yet in this course, but it's the input process output model. So companies can analyze vast amounts of data to uncover relevant information that we didn't have access to before. So we're looking for hidden patterns, correlations, market trends, customer preferences, other pertinent information. And then we use that to reduce cost, to determine new product offerings, to provide better customer service and improve efficiency. Okay, the most important thing is that we can make better, more informed decisions. So we didn't have access to this information before, and we didn't really have the tools. Now we have both. Okay, but learning how to use it takes time. And when you graduate from this program, you might know more about analytics than the people that are in business in the company that you go to. Okay, at least your peers, the people at your level, because you'll be on top of it. So what we have is a big data strategy. This is how we use it. And this clarifies how data will be used and what data the company might need to collect to create new opportunities. Okay? So the hard part is trying to determine which data is valuable and relevant, because the data itself is limitless. So we really need to, hone in on what we really are interested in. And then business intelligence leverages data tools, and best practices to help managers make data-driven decisions. Okay, so you can reach your goals. Financial reporting is often used for decision making. Other types of data not captured within the GL, okay, are unemployment rates, outsider ratings, expected tourism, competition, COVID. Okay, those really important external indicators are not included in traditional financial reporting. Okay, this is just a result of past activity. Okay, not to diminish it, but that's all it is. So what we do is we use technology to convert it, and we've got ERP systems, and this is all changing now though. It's an integrated business management database that uses to collect, store, manage, and interpret structured data for its core business enterprises. Okay, there's something now called a data lake that you might want to, I'm going to say watch for data lake. We'll talk about it in class a little bit. It's changing all of this. I'll talk about it later. And then SQL, this is if you have a chance to, if you get some extra credits and you want to learn a language, this would be a great one to learn. It's an old language, but it is used all the time now. And it's a query language used to request information from a relational database system like an ERP. So anything with relationships. And it's very flexible. It can be used on a lot of different types of data. And then machine learning, or AI, as you know, can be used to collect and analyze unstructured data. Okay. Considerations for outputs when building a management accounting information system. What format, how you want your format, how you want your output, how frequently you need it, what should be included, and who will be using it. Okay, believe it or not, when you design a system, you really think about what you want to get out of it first. Okay, you think about reports, and you make sure that you're paying attention to the information needs of the organization. Okay, now we're getting there. Core competencies required of today's accountant. The IMA, that's the Management Accounting Group, they've got a core competency framework. Okay, and we're going to look at a little bit at the role of the management accountant. It's changed quite a bit over the years. So the IMA identified 6 domains of core knowledge that a managerial accountant needs to have to be relevant in today's environment. So you need to know about strategy, planning, and performance. Okay, strategy I find the most interesting. I really like it. And then having a plan to, support your strategy. Reporting and control, that's an old skill of ours. Technology and analytics is new. business acumen and operations. Knowing more about the business in the industry, I think, is more important today than it ever was in the past. Leadership. Okay, leadership is one of those softer skills that an accounting major may not pay much attention to, but it's really important. And then finally, professional ethics and values, which is also important. Okay, so that you can fulfill your role with competence and proficiency and fidelity. That's what you're looking for. Okay, so this is the input process output model, and this is where you gather quantitative and qualitative information, and then we use machine learning and AI. It makes it easier to analyze unstructured data and evaluate their performance against KPIs, key performance indicators. And then finally, the output managers often use many other key metrics to evaluate performance. We've got dashboards that we report to. You report on the key performance indicators, especially on a dashboard, to monitor performance. These are all things that we do. Okay. And here's a statement, a comprehensive income statement. There we've got sales, 80% are credit sales. This would be, we're looking at common size statements here, so we're looking at it as a percentage of sales, right? So our sales are 100%. You can see that this is year 1 and there's year 2. Cost of goods sold has decreased. Gross profit has increased. That makes sense because the cost has gone down. Selling and admin expenses have gone down. There's operating income. And then when we get down to net income, we can see that net income has increased. Okay. Here's the comprehensive statement of retained earnings in this company. Here's our beginning balance of retained earnings plus net income minus dividends. There's our ending balance, which would go onto the balance sheet. We're really almost done here. I think this comes over better in the textbook. Here's our comprehensive balance sheet. Let's keep looking here. I might stop here. Cash flows. Okay. Okay, so we've got the basic statements up above, and then this would be the ratio analysis that we would look at. So we've got 1, 2, 3, 4, 7 ratios here. Working capital, current ratio, and quick ratio. You should pretty much have a good idea of. You can see here that the quick ratio is much lower. Here's accounts receivable. Okay, there's last year, this year, so it's gone down. Inventory turnover has decreased. Earnings per share, and then little kitty, and then debt to equity. 1.2, 1.01. That's gone down a little bit too. Okay. These are some visualizations. This is also a good way to use your analytical tools because, you know, a picture's worth 1,000 words. And you can see right off the bat the cost of goods sold here in 2021 was 58%. 2020 it was 61%. So it's a smaller size of the pie. Nothing here is that dramatic though. Okay. SG&A has gone from 25 to 22.8. And it looks like we've completely lost a slice here. I don't know what's happened to it. Okay. But these are expenses as a percentage of total sales. We're almost done here. These are all visualizations, all things that you would want to prepare. Okay, here's our current ratio. And you can see an image is much easier to understand than just looking at the numbers. So the current ratio is really increased. There's the industry. We're way up above it. But when we look at the quick ratio, okay, then it's a little bit more comparable. Okay, so we don't know what's really going. You'd have to look at the numbers to see what was happening. There's the industry, and we're a little bit slightly below it. Okay, almost there. 2 more slides. Here's some accounts receivable turnover. Here's the industry. Our accounts receivable turnover has gone down. Inventory turnover. Here's industry. This has really gone down. So here you would want to know more information or figure out what's happening here. Okay, I don't know what's happening here. And finally, these are sales by month. These are operational visualizations. And you can see this is what our budget was for 2021. Nice straight line. but the actual went way up in August and then down in October. So maybe there's something cyclical happening in here that the budget didn't account for. Okay. All right. But this is the kind of information that we get out of analytics. We're able to maybe get a deeper understanding of what's happening from our financial ratios. Okay. Or a ratio analysis. But the images are really good. Like the sales by month is a really good chart. Okay, that's it. That's enough. It's more than enough, huh? Okay.